Okay, 104.5%. That is a massive number, right? Well, what if I told you that in just the first quarter of 2026, a major player in the semiconductor equipment industry saw their incoming orders surge by exactly that amount? We're talking about a company whose tech is quietly powering the entire AI revolution. But honestly, their massive market valuation is leaving analysts completely divided right now. So is it justified, or are we looking at a bubble just waiting to burst? Welcome to today's Explainer. I'm super excited to guide you through this one. We are going to be diving deep into the Dutch semiconductor equipment giant B Semiconductor Industries, though most folks in the industry just call them Besi. We're going to objectively unpack their underlying fundamentals, that staggering recent growth, their sky-high valuation, and the sustainability metrics driving their long-term strategy. We've got a lot of really fascinating ground to cover today, relying entirely on the hard data and their latest 2026 corporate filings. Here's our roadmap. We'll start with that explosive first quarter growth surge. Then we'll unpack their valuation, specifically that towering PE ratio. After that, we'll explore how they're rewarding shareholders, and finally, wrap up with their sustainability and ESG targets. Let's jump right into Section 1, the Q1 2026 growth surge. To really get what's going on with Besi right now, we kind of have to contrast it with where they were just a year ago. In the full year of 2025, things were, well, a bit sluggish. They actually saw a revenue decline of 2.7%, mostly because the mobile, automotive, and industrial markets were going through this broad-based weakness. It was a tough cyclical period. But then, fast forward to Q1 2026, an absolute explosion. Orders hit nearly 270 million euros, surging 104.5% year over year. So, what changed? In two words, AI computing. There was just this massive spike in bookings for advanced microchip packaging tech, specifically stuff like hybrid bonding systems and photonics. Basically, this is the ultra-precise equipment used to glue microscopic chip components together so they can process data fast enough for AI. They essentially caught the AI wave perfectly. And it's not just order hype. This is translating into real money. Digging into the Q1 financials, revenue hit 184.9 million euros, which is up over 28% year over year. But you really want to pay attention to that net income line. Net income skyrocketed nearly 64% to 51.6 million euros. How do you get net income to outpace revenue growth that aggressively? Super strict cost control. They kept their operating expenses on lockdown, pushing their net margin up to an incredibly healthy 27.9%. Plus, gross margin stayed rock solid at 63.5%. Basically, fundamentally speaking, this business is firing on all cylinders. Which brings us to Section 2, unpacking the PE ratio. Because the real question is how the market is pricing all this explosive growth. Based on the latest financial reports up to May 2026, Besi is trading at a staggering price-to-earnings, or PE ratio, of 142.50. Just let that sink in for a second. For every single euro of earnings, investors are willing to pay over 142 euros for the stock. That is a massive premium. It tells us the market firmly believes this AI-fueled order growth isn't just a temporary blip. They're pricing it like it's the beginning of a massive, sustained upward trajectory. To put that 142 PE into perspective, let's look at some of their tech peers. You've got ASM International, right? A total giant in the semiconductor space, and they're trading at a PE of around 44. Companies like NADAP and TKH Group are way down in the 20s. Besi's valuation just absolutely towers over its traditional peers. Honestly, among this group, you have to look at a company like TomTom, sitting at 145.62 to find anything priced even remotely similarly. Right now, Besi is literally priced for perfection. And if we zoom out and look at Besi's own track record, this current valuation is a total outlier. Their 10-year average PE is roughly 34. The 5-year average is 47. Even if we just look at the boom times over the last 3 years, the average was around 65. So sitting at 142.5, that represents an 85% jump compared to just the average of the last 4 quarters. It's wildly clear that the market's entire paradigm for Besi shifted fundamentally between 2025 and 2026. Let's move on to Section 3, rewarding the shareholders. You might think that with a valuation that high, management would just be hoarding cash, but actually, they are incredibly proactive about rewarding their investors. Remember earlier when we talked about 2025 being a slightly weaker cyclical year? Even during that dip, they maintained a super generous capital allocation policy. They proposed a dividend of 1.58 euros per share. That is a payout ratio of 95%. They essentially returned almost all of their net income directly to shareholders. That signals immense confidence from management in their ability to keep generating really strong future cash flows. On top of those dividends, they're actively buying back their own stock. Take a look at the snapshot of their trading activity from mid-May 2026. As part of this massive 60 million euro share repurchase program they announced late last year, they were aggressively buying back roughly 900 to 940 shares almost every single day. And they were doing this at prices hovering around 254 to 265 euros a pop. So management clearly believes that even at a 142 PE ratio, investing in their own company is still a smart use of their capital. Finally, Section 4, Sustainability and ESG Targets. Because securing long-term value in the 2020s isn't just about financial engineering, right? It requires future-proofing your operations. And the broader market is absolutely recognizing Besi's efforts here. They secured the second highest possible ESG rating from MSCI at an AA. Sustainalytics ranked them third out of 366 semiconductor companies for managing ESG risks, giving them a negligible risk score. They've also hit prime status with ISS and improved their CDP climate score. For institutional investors with strict ESG mandates, Besi screens as a top-tier asset. But they aren't just coasting on good ratings, they're backing them up. By the end of this year, 2026, they are targeting 85% of their global energy needs to come from renewable sources. They also want a 75% reduction in Scope 1 and 2 carbon emissions compared to their 2021 baseline. And looking ahead to 2030, the ultimate goal is total carbon neutrality, net zero Scope 1 and 2 emissions, and using 100% renewable energy. What's really impressive to me, though, is how they're forcing this accountability deep into their supply chain. They're not just cleaning up their own house. Back in 2025, 70% of their purchase volume came from vendors who had actively signed their strict general work agreement, or code of conduct. For 2026, they are pushing that target up to 80%, aiming for 85% by 2030. They are literally auditing their suppliers to ensure human rights and environmental compliance. It is a very holistic approach to doing business sustainably. So as we wrap up this explainer, I want to leave you with a provocative thought to chew on. On one hand, you have this staggering 142 PE ratio that would literally leave a traditional value investor gasping for air. But on the other hand, you're looking at a company posting 104.5% order growth, fueled by the AI boom, generating incredible margins, paying out 95% of its earnings in dividends, and perfectly executing a top-tier ESG strategy. So does all of this incredible growth and execution truly justify that massive premium? I'll let you be the ultimate judge of that. Thank you so much for joining me today to unpack all of this and keep learning.